Ever wondered how institutional traders know exactly where to enter and exit their positions with 100% accuracy? No, it's not insider information or complex algorithms. It's their ability to see where massive buy and sell orders are clustered at specific price levels. And in this video, I'm going to show you a powerful tool that unveils the market's hidden supply and demand zones. And if you stick around till the end, I'm going to show you how to combine this indicator with a simple support resistance tool to create entries so accurate, you'll wonder how you ever traded without it. Let's get into it. First, head over to Tradingview and pull up any market you want. I'm using the 5-minute time frame on EURUSD, but this works on any time frame and market. Click on Indicators and type in Activity and Volume Order Flow Profile. Make sure you select the one by Algo Alpha. This indicator doesn't just show you overall volume, it also breaks down the actual buying and selling pressure at each price level. It's like having X-ray vision into what's really happening behind price movements. What makes this indicator so powerful is that it shows you exactly where institutional traders are placing their orders, levels where price is most likely to react, giving you a massive edge over retail traders who only see price action. Now, if you take a closer look at it, you'll notice there are two main modes, the comparison mode and the net order flow mode. In comparison mode, each horizontal bar is split into two sides. The left side, typically green, shows buy volume, while the right side, typically red, shows sell volume at that price level. This lets you instantly see the volume imbalance at each level. For example, at this price level, you can see the buy volume significantly exceeds the sell volume. This signals strong buying interest, a potential support zone where price is likely to bounce. Conversely, at this level, sell volume exceeds buy volume, creating a potential resistance zone. But it gets better. The indicator also highlights something called the point of control, or POC, the price level with the highest trading activity. This particular feature is absolutely critical to our strategy. A bullish POC forms when buy volume significantly exceeds sell volume at a particular level, which often act as strong support zones. A bearish POC forms when sell volume dominates, creating likely resistance. Now in the net order flow mode, instead of seeing buy and sell volumes separately, you see a single bar showing the net difference. Positive values indicate net buying pressure, while negative values signal net selling pressure. This gives you a quick visual snapshot of where buying and selling pressure is concentrated. But before we go further, I should warn you, not all POCs are created equal. To differentiate a high probability setup from false signals, you need to know something called the volume threshold. For a POC to be valid in our strategy, it needs to show a significant volume imbalance. As a rule of thumb, you want to look for at least a 30% difference between buy and sell volume. For example, if the buy volume at a level is 100,000 and the sell volume is 70,000 or less, that's a legitimate bullish POC. Anything less than a 30% difference is too weak to be reliable, and you can visually identify strong POCs by the length difference between the green and red sides of the bar. The greater the disparity, the stronger the level. But that's not all, because volume spikes are equally important. POCs formed with massive volume carries more weight than one formed with average volume. Look for POCs where the total volume exceeds the average volume by at least 50%. These indicate significant institutional interest and are much more likely to act as strong support resistance zones. Setting these minimum thresholds eliminates 70% of false signals. But here's the truth. Trading like this without a complete system, it's the fastest way to blow your account, because it's not just about one indicator. You need everything. Smart entries, volume confirmation, proper risk, accurate exits, all working together. While the volume order flow profile shows us key institutional levels, we need a way to identify precise entry triggers so you don't get stopped out right before the big moves happen, because without proper entry timing, even the best volume analysis becomes useless. This is why we add our second indicator, Breaks and Retests by Han Gaddy. To add it to your chart, head over back to Tradingview and search for it in the indicator menu. This indicator automatically identifies support and resistance levels, then labels them when they're broken and subsequently retested by price. When price breaks through a resistance level, the indicator marks it with a break label. When price later comes back to test this broken level, which now acts as support, it labels it with a retest. The same applies in reverse for broken support levels. What makes this combo so powerful is that we're now seeing both key institutional volume levels and price structure working together. By waiting for structural breaks and retests to align with institutional volume levels, we create a trading approach with precision that's nearly impossible to achieve with other methods. Now let's put all these together to create a winning strategy. For long entries, first, you want to identify a resistance level that gets broken. The breaks and retest indicator will label this with a break when price pushes through. Second, wait for price to return and retest this broken resistance. The indicator will mark this with a retest. This is important as we never enter on the initial break. We only enter after price confirms the level has flipped from resistance to support. Third, locate a bullish POC from the volume order flow profile. This is where institutional buyers have shown significant interest. Fourth, enter your long position when price breaks and closes above the bullish POC. This confirms that momentum momentum is strong enough to push through this key level. Set your stop loss just below the most recent swing low, typically the low of the retest candle. For take profit, target a minimum 1.5 times your risk. You can extend this to 2x or even 3x in strongly trending markets. For short entries, first, identify a support level that gets broken and labeled by the indicator. Second, wait for price to retest this broken support, now acting as resistance. Third, locate a bearish POC from the volume profile. Fourth, enter short when price breaks and closes below the bearish POC. Place your stop loss just above the most recent swing high, typically the high of the retest candle. Target at least 1.5 times your risk for take profit. Quick note here, as short entries often have some unique considerations. They tend to move faster than long entries due to the nature of downward momentum, so I recommend taking partial profits at 1-to-1 risk reward, then letting the remainder run to your full target. Also, be particularly careful with shorts against the major trend. This strategy works best when your short entries align with the higher time frame direction. Now, different market requires different settings. Here's how to optimize for each. For Forex pairs, look for POCs with at least 40% volume imbalance for major pairs. Focus on the London and New York sessions overlaps for the cleanest setups. The 5-minute and 15-minute timeframes work best. USD, GBP/USD, and USD/JPY show the strongest reactions to these institutional levels. For crypto, increase your volume threshold to 50% imbalance to account for higher volatility. Widen your stops by approximately 15% from the normal placement. The 15-minute and 1-hour timeframes provide better reliability. Focus particularly on BTC and ETH, where institutional participation is highest. For stocks, pay special attention to pre-market and post-market POCs. These often become key levels during regular trading hours. Use the daily timeframe for swing trades and the 5-minute timeframe for day trades. Volume spikes around earnings announcements create particularly powerful POCs. For futures, contract rollover periods create exceptional volume imbalances. Session openings, especially for ES and NQ, create the strongest POCs. The 30-minute time frame offers an ideal balance of signal quality and frequency. If you found this helpful, smash that like button and hit subscribe for more trading tips that actually work.